Hi guys. Today we will analyze Smith & Wesson stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a bad performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $13.20 and $9. Next strong support level is around $6. Strong resistance levels are around $15.20 and $18.50. Next strong resistance levels are around $21 and $25. In the last month the stock has been trading between $13.20 and $15.90 range. It is currently trading near the lows of this range. The stock has an average volume of 1 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since July 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 8% per year, for last 5 years. We see that the average profit margin of the stock has been around 11% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 117% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Smith & Wesson Company: bad, average, and good. First scenario. Smith & Wesson will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, -5%. Future profit margin would be low, 10%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $9. Second scenario. Smith & Wesson will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, -2%. Future profit margin would be average, 11%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $14. Third scenario. Smith & Wesson will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 1%. Future profit margin would be high, 12%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $19. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.01. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Smith & Wesson, analysts forecast growth rate around -5% per year in next 5 years, and future P/E around 3. Again, I will use 3 different scenarios for Smith & Wesson Company: bad, average, and good. First scenario. Smith & Wesson will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, -5%. Future P/E would be low, 5. In this case, the fair value of the stock today would be $7. Second scenario. Smith & Wesson will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, -2%. Future PE would be average, 7. In this case, the fair value of the stock today would be $12. Third scenario. Smith & Wesson will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 1%. Future PE would be high, 9. In this case, the fair value of the stock today would be $21. As you can see, today the stock is fairly valued, $13, if we expect the company's medium-high performance in future. The fundamentals are great, and the company is debt-free. However, the company is expected to show a negative growth in the revenue in the next 5 years, -5% yearly. It's bad. Despite the negative growth, the stock still looks fairly valued at the moment. The stock has been in a downward trend since July 2021, and it can go lower, before it recovers. I own the stock, but I have sold it recently. I think the company faces significant regulatory and political risks, especially after the recent high-profile shootings in the U.S., in May-June 2022. So, it's too risky to hold the stock at the moment in my opinion. I still like the stock at the current levels, but I just need an extra margin of safety, due to an unfavorable business environment. I may consider buying the stock again, when the stock drops to $10. Company strengths. Smith & Wesson Brands is an American firearms manufacturer, headquartered in Massachusetts. It's the largest manufacturer of handguns in the U.S., and one of the most recognizable brands in the world. They manufacture and distribute a full line of firearms for defense, law enforcement, hunting and sporting. The company provides products that are utilized by virtually every police agency and military force around the world, and the Smith & Wesson Academy is America's longest-running firearms training facility for law enforcement, military and security professionals. The company operates a durable business, which can weather short-term volatility, stemming from market disruption. To diversify and add breadth to its brand, the company licenses its name to makers of apparel, watches, sunglasses, gift sets and more. The company has a strong balance sheet, and it's debt-free. The company's return on assets of 53%, return on equity of 76% and profit margin of 25% are amongst the best returns of the industry. Risks. The sector in which this company operates offers few opportunities because it is already saturated and subject to many regulations. The company is dependent on third parties to purchase materials such as steel, wood, lead, brass and plastic. Only 7% of their sales are produced from international venues. A vast majority of their sales are in the U.S. market, and while they are an international company, their sales and market share in foreign markets are low. The company faces significant regulatory and political risks. On September 30, 2021, Smith & Wesson announced plans to move its headquarters to Tennessee in 2023, citing an unfavorable business environment in Massachusetts. Smith & Wesson does not have a reliable dividend history, since the company has only paid a dividend for 2 years. The company is expected to show a negative growth in revenue and in earnings per share. In the coming 5 years, the revenue will decrease by -5 to 8% yearly. In the coming 5 years, the EPS will decrease by -10 to 15% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.